Everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are talking about, give you my financial opinions on what's going on there. It's going to be commodities, financial topics, or wealth building areas. So if you want to follow me on Twitter, it's at finding_finance. If you want to join our community, it's finding-value.com. We still have a September discount coupon code. It's called September for the coupon code. If you want to try the first month at 50% off to try it. So we'll start with bonds are heading for a third year of losses for the first time ever. And this is the history back going all the way to the 1970s. And this is the losses in bonds. Look at this year here. What happened there is a lot of people sold bonds, not as many people bought them. That's the easiest way to sum it up. That's your interest rates going ballistically higher. Do we have a problem with the bond market? That's a really good question because we've got 3 years of losses, and one of those years is massive. So, is there a problem in the bond market? I don't know. There could be. We could be having a bond crisis. If you look at other years, you can see that there were single years that it was down, and then you can see that there were years they were massively up. So again, generally speaking, you'll see these big up spikes after crashes in the real estate market. So in 80, we had a crash. In 75, you could see a big move up in bonds in the middle of the 70s. That was that pullback. So when you see pullbacks of inflation or slowdowns in the market, generally we see bigger outperformance years in bonds, where you go from a high interest rate to a lowering of interest rates, which drives prices higher. Now, are we going to see coming after this move a slowdown in the market, a potential recession, and people running into bonds, which then would see a large up candlestick? I don't know. That's kind of what I'm interested to see. That is also if we go towards the end of a real estate market, we overbuild in the real estate market and we have forced selling. Generally speaking, bonds outperform during that time frame. So you could see a big downside move in bonds and then behind it a big upside move in bonds if the bond market is completely healthy. And that would be from a slowdown in the market, unemployment, and a potential hyper supply phase in real estate. Razor Oil, he says, Lesmer entire asset oil production increased by 20% in 3 to 4 months into $90 oil. I love it when a plan comes together. This is Athabasca Oil, their Lesmer field. So 24,524, that's barrels. And we saw a gigantic 20% increase in oil production. So if we look at this, you can see Athabasca's new 5-well pad was brought on in Q2 with Leismer volumes tracking ahead of prior year-end guidance at 24,000 barrels per day. This is the production curve. You can see that we are way up there in 2023, surpassing other estimates and surpassing previous production all-time highs. So this is one of the companies that we are in on the website. And there are other companies that look absolutely fantastic that are increasing production over the next few years at 30, 40, 50% clips. Some of them are doubling their production. And we're doing that in an environment where the oil price is increasing. That is going to equal insane returns. Insane returns, guys. It says, dang, talk about melting ice cubes, paging Lacey Hunt. It says the principal value of US 20 plus year treasury bonds, adjusted both for inflation and interest rate reinvestment, is minus 54% from its all-time high in 2020. This is a massive move lower in bond prices. Now, if we kind of dissect this a little bit, you can see it's like first wave, third wave, fifth wave. And I do think that we're putting in a double bottom here. I'm guessing. And I do think that we could go higher in bond prices at some point in the future. I think we're going to see a slowdown. I think rates could go up, and perhaps people run to bonds at some point. I'm not stating that this is the absolute bottom. It could be, but we do have support underneath us at the pricing that we're at in bonds. What I will say is money rotated out of bonds here, a good chunk. And they continue to release more and more bonds, basically drowning anyone who's in the bond market with new issuances of bonds. So I think we're going to have an increasing interest rate environment. I think inflation will remain elevated, but that doesn't mean that we just go straight down. So I'm sure we're overdue for a bounce in bonds. We've had 3 down years, and maybe we get a slowdown in the market in 2024 or something like that. It's possible. It says, I'm still not interested in buying the 10-year. Look at this. This is bonds more expensive. Even though we were down, looking back here, 54%, pullback. It says a measure of the 10-year bond valuation using real yields and the 3-month 10-year curve. It's still, bonds are more expensive. It's still overpriced. I mean, given where the market conditions are today, that is crazy to me. Just crazy. We should be more expensive. We should have higher interest rates than where we are today, is what this chart is telling us. It's still saying that bonds are still expensive. It's crazy to think that with the underperformance that bonds have had. Crazy. Preston says, California banging out $5.79 gas prices right now. I'd love to see the diesel prices. Conventional oil production has now unequivocally rolled over. Unconventional production, the only source of growth in global oil supply over the last 12 years, has also significantly slowed. The only growing non-OPEC basin in the Permian is in the Permian in West Texas. Never before has oil supply growth been so geographically concentrated. 6 counties in West Texas are now 100% responsible for all global production growth. At the risk of repeating the obvious, the 6 counties in West Texas that Go Rosen said on June 1st were responsible for 100% of all global production growth is now rolling over. This is occurring as the world is struggling to make enough diesel. So where gas is the cheapest, where is it the most expensive? West Coast the most expensive. Cheapest is the South and Southeast. How much is your gas prices? Put it in the comment section. My gas price when I last filled up was $3.59. So I'm in this region in Colorado here. I was $3.59 is what I paid the last fill up. Let me know what you guys paid your last fill up. Just curious. Now we've got Morgan Stanley says the Fed is done raising interest rates and will start cutting rates next year. That will also lead to bond prices moving up. It will also, or it could also mean that there's weakness in the market, potentially. It will also spur more lending in the housing market if they were to cut rates, which means that commodities are still in favor. We haven't gone into a hypersupply phase of the real estate market. So we're still in the expansion phase of real estate, which means that, guess what? Commodities are still game on. It says, my Uranium brothers, took me a while to understand this. Take it to heart, this bull market. Money is made by sitting, not trading. All of my biggest gains have been where I've purchased something very cheap, I've waited, and we've gone to much, much higher levels, 20, 30, 40 baggers. And that is where your life will change. Your life will change when you learn to sit, not to trade. What I'll say. Are you afraid to stand alone? It says, I believe that the public wants to be led, to be instructed, to be told what to do. They want reassurance. They will always move in mass, a mob, a herd, a group, because people want the safety of human company. They are afraid to stand alone because they want to be safely included within the herd, not to be the lone calf standing on the desolate, dangerous, wolf-patrolled prairie of contrary opinion. Jesse Livermore. Are you one of those people who are afraid to stand alone? I'm not. I can make my own decisions. I've got my strategies and my things that I follow, and that's generally what I follow. Some could tell me that, maybe their name's Kathy Wood, that oil cannot go above $20 or $30 a barrel again. And here I am loading up on oil in 2020, telling people that oil is probably going to go 250 plus a barrel by the end of the bull market. How did I have that vision? How did I have that foresight? How did I know, or not really know, how did I have that opinion? And why was it contrary to everyone else? What you're going to find out is the herd and the majority is oftentimes, well, it's going to have to be wrong. Where their money is where the majority of the money is at. You have to be where the majority isn't. That is how you make money. So if just do opposite of what basically the herd is doing, just do opposite. It's almost what you need to do. If they're all over buying Nvidia, do not buy Nvidia. If they're all over doing something, don't do what they're doing. Here's uranium. Where would it be in 2024, 2023? You can see a big move up. Last run in 2006 and 7, we had a move up, a consolidation, and then we had a big move up to 2007. It was a 7 months run in the physical price. Are we going to get a 7 month run all the way up here to some degree? I don't know. We'll find out, guys. We'll find out where we go here. And if it does that, that's probably, he's got a doubling of the Sprott Physical Uranium Trust. Maybe it's a double, maybe it's more. I don't know. We'll find out there. As the cracks in the U.S. labor market are becoming more and more evident, the rate of permanent job losses is currently escalating at its swiftest pace since the major economic downturns of the past 30 years, marking the 6th consecutive month of such increases. It's worth noting that the current strength of the labor market has been camouflaged by the sustained demand for lower skilled job positions. Layoffs in higher paying professions are occurring more frequently, and consumers are feeling the strain of the significantly elevated cost of living. This is your US permanent job losses. And generally speaking, when job losses go up, we see slowdowns in the market in general. A lot of this slowdowns can occur from the US construction cycle. So this here is, that was COVID. They shut everything down. It was probably a job loss across the board. This was the slowdown in the housing market, and a lot of job losses were lost around the construction cycle. And this one was the tech bust. It looks like we've got some losses here in terms of permanent job losses, and we don't know how big this is going to be. It could be a small slowdown, and then we get a larger slowdown later on. Is the tech bust similar to this one? I don't know. We'll see. But we are increasing in terms of permanent job losses, which is generally a sign of a slowdown in the market. This is North Star. He says, where BlackRock goes, Bitcoin and crypto follows. Game over. The party has been and will continue to be elsewhere, like uranium. So this is BlackRock versus Camco. And what you're seeing here is you're seeing a sell-off. You know that red army I talk about? Big sell-off, and then it comes up slowly. Big bullet, bearish engulfing here. Another bearish engulfing here. That's a double top. And here we are going down lower. And then we've broken a major support level for the long-term big picture view. What does this mean? It's telling you the market conditions that we're under. That's really what it's telling you. It's telling you that financial assets could potentially underperform a lot of these commodity sectors, which are hard assets. And I think with this chart, it's telling us, wow, we could be shifting into a very big outperformance for companies like Camco, uranium, oil, and a lot of other commodities. It is telling us the market conditions. And generally speaking, when the bottom occurred, it occurred in 2008 9. That was the top for Camco. And this was a recovery phase of real estate. This recovery phase, money flows into the tech sector, flows into these kind of S&P 500, the regular kind of stocks that consume commodities. And this is a financial company, BlackRock's financial. So the financials also do quite well under a recovery phase and even an expansion phase. So it's telling us the conditions are changing. He says, as a finding value member, I highly recommend Andy's service. Insightful educational opinions welcome, and comes down to the individuals making their own decisions based on their own due diligence. Looking forward to Sunday's night. Talk and listen on what is on people's minds. Thank you for that feedback. It's pretty hilarious, all the arguments against oil, investing in oil companies. We won't be using it anymore soon, so I don't want to buy oil stocks, is the generalist. Ban all fracking and stop using oil now. Meanwhile, every pundit is like, the economy will crash with oil over 90, which is like $63 in 2010 dollars. People awfully concerned with something they deem is uninvestable because it's not relevant or because they think we don't need it anymore. You see in real time what happens if you just start taking oil away. The price goes up, and then all of a sudden, everyone feels pretty messed up. Because the only alternative is less energy. Anyone who has really stopped to think about it doesn't want to consume less energy. And if you read some of these responses here, these people are, I mean, guys, they are all sorts of messed up. So what's the fact here? Oil is the number one commodity. We can't stop using it in its entirety. We can try to slow it down, its uses. I still don't think we can do that. I don't think we can lower the consumption of oil without having a reduction in prosperity. That's what I think. So if people want to be richer, if the third world countries want to become wealthier, we're going to consume a lot more oil. And the problem is, I don't know how much more production can increase over, say, the next 20, 30 years. I do think that we're going to hit a wall, and I don't think we can produce maybe as much as the world wants to consume. I'll just say that. So I think oil is a very good investment, very good for a long-term hold. Gold went down minus 65% from 1980 during the last major inflation cycle, and it took 30 years to break even. If your investment strategy is to buy and hold, you should never touch gold. That's what his opinion is. Buying it in 1980 is the absolutely worst time to purchase gold. And what I'm going to say is, and he's probably comparing it to the current setup in the 2020s, 2020, 2023. What I'm going to say is it's completely dependent on inflation and the market condition. So gold is the best investment. It beat the S&P 500 and everything else if you purchased it in 1970. It would also have been a very good investment in the early 2000s. What you want to walk away with is gold has its time in the sun, and it also becomes overvalued. In 1980, gold was overvalued in relationship to the money supply. It was overvalued in relationship to stocks. It was overvalued to a lot of different assets. Today, it's the exact opposite. It's undervalued to the M2 money supply. It is undervalued when priced against the Dow Jones or the S&P 500. That is the whole reason I set up the strategy that I deploy, is that people can have these opinions. They can try to look at the charts and determine certain chart patterns and try to decipher, well, this pattern means this, that is where your ratios and your market conditions come into play. The ratios are stating that gold is, in fact, cheaper than it's ever been. And this opinion is going to prove to, in my opinion, to be a really bad opinion. If you also look at the gold production is going to fall here. Every single time we had massive rise in gold, we also had falling gold production. So I think that gold's going to go up massively. I don't know the exact pricing. Maybe it goes to 3, 4, 5, 6, 7, 8, 9, 10 grand, something like that. I know it's a big overarching valuation. It depends on how much money runs at it. Depends how scared people get, and it depends on the conditions that people are subjected to. But I think this is completely wrong. I wanted to share an opposing viewpoint, which really doesn't really, not really an opposing viewpoint. There's not really any data here. He just has two charts that he tries to put as a topping pattern, which I disagree with. And this could go down in the short term if we get a slowdown in the market. I'm not stating that it can't go down, but overall, the big picture view, it's going to go up from an inflation perspective and the increasing interest rate environment. This is uranium, Denison mines. I know John loves Denison mines. Fundamentals are greater than any other times. He thinks that we could probably go back up this upper level. This is kind of the basing pattern that occurred in the mid to late 2010s. We had our consolidation and we've broken out of that consolidation. Looks fantastic. Grady states inflation is normally a sign of increasing demand and a reasonably healthy economy. The inflation we are getting now is not. It is grounded in debt and a currency debasement war. Hard assets is the way to go. Do not miss the commodities bull as it will literally save your life. What does he mean by that? He's stating that debt is the problem, commodities is your safe haven, and the inflation could get bad enough where commodities could literally save your life, those investments. There could be other investments that are getting destroyed, like bonds in a highly inflationary environment that is driven by debt and currency debasement. That is the root of where he thinks the problems are at. So do I. I also think that there's a problem in the debt. And we saw that earlier when we talked about the bond market going down for 3 straight years. Something is different. It seems weird. And it's grounded in currency debasement and problems with debt. This is the Black Swan event about to spike uranium again. Twice in the past 50 years, the price of uranium has shot up 600%. Both were due to a Black Swan event, one that cannot be predicted but completely alters the landscape of an industry taking place right now. Uranium price 14x, 12x, and we've got another one that is coming that's going to move uranium price to a ridiculously high level. This is a new era has arrived. Tell me again why you've been holding Apple instead of Camco. This is Apple versus Camco. You can see that Apple was outperforming Camco. And why did this occur? Money flows into technology stocks under a recovery of real estate, recovery era. It's a low inflation, low interest rate environment. So from 2008, it broke out and then we went higher and now it's topped and we're breaking back down. What does this mean? It tells us that the market conditions are changing and that uranium companies, commodity companies are going to start to outperform the tech sector. Just period, guys. You can take any tech company, price it against any of these other companies, and you're going to see a breakdown. It means that we should be looking at gold and silver and commodities. That's really what it means. We did a Doomberg interview there. JP Morgan, we forecast a 1.1 million barrel per day supply deficit gap in 2025, widening to 7 million barrels per day in 2030, driven by both a robust demand outlook and limited supply sources. Now, this will never transpire into an actual deficit because prices are going to solve this. So basically, when you look at these charts, it's a supply and demand shortfall based off of current pricing. is really the way that you want to look at it. And if this is the case, I think that it would be highly smart to be looking at potential energy sectors to invest in, like oil, like natural gas, like uranium, because there are squeezes coming up in a lot of different metals, energy, and all these different things. And over the next decade, I think is going to be one of the best times to invest in commodities in anyone's lifetime because of these deficits. And these deficits, they all look the same. It's in all the metals, it's in all of energy, and now we're just starting to get started in the big move, where this all starts to kick in over the next few years. An energy super cycle could send oil soaring to $150, warns JP Morgan. An oil spike to 150 gets very bullish on energy stocks. September 22nd, 2023. Really, I'm pretty sure I'm pretty bullish on oil too. You're going to start to see this in the headlines more, so get used to it. All these new uranium funds about to launch, how will they even work as there seems to be about 0 pounds of uranium for sale? Yeah, that's the problem, guys. There's no uranium for sale, and there's going to be a squeeze. And I said, I think this is what everyone is pondering. What happens when uranium goes extinct with a bunch of bids? I don't know. I don't know. The price could go, I think, surging higher is what I think. This is the Baltic Dry Index. Strong, the channel's broken, and the blue neckline is taken out. If you look at the inverted shoulder, head, shoulder, we're breaking out of it. Baltic Dry Index looks fantastic, guys. We could see a big move in the Baltic Dry Index, and it also looks good on all the ratio charts. Simple math below on the impact of non-OECD countries industrializing on oil and electricity demand. The numbers are staggering. I miss speaking with Cornerstone Mike Rothman, who, aside from being very generous and thoughtful guy with a ton of levity, would remind me that if China goes to Mexican oil demand per capita, that increase is greater than the US total oil demand if China goes to Mexican oil demand. The caveat being that this is all known and will take time. India ramping and Middle East growing just huge for demand. The great whale of demand growth left, assuming China is slowing a lot, is Africa. 1.5 billion people, the same size as India or China, that barely uses hydrocarbons. This is the coal story, the oil story, the chem story, the gas and LNG story. Okay, this is just the story. Guys, there is a large group of people, half the earth, using very little energy. And if they want to become wealthier, they are going to consume a butt ton more energy. And guess what? It's going to strain the entire world if they try to become wealthier. And I hate to say it, but everyone wants to become wealthier. They want to use and consume more energy. Coming down, EU versus Camco. Cut it off there. So we're starting to head higher. It's breaking to the upside where Encore Energy could start to outperform Camco. We're starting to see a lot of the developers and the small cap exploration companies start to outperform Camco. So I think that occurs during the third leg or third wave, and I think that's what we're entering, based off of all of these outperformances of the developer companies. If you're investing in the stock market, you've been wrong for 3.5 years. Commodities are really where it's at, and you can see commodities are starting to break up. You put an arc in there, and we hit the arc, and we're starting to move on up where commodities will start to outperform stocks again. So it looks good, guys. And you can see the MACD starting to come back and turn around here for another big, hopefully a big move up for commodities if you're invested in commodities. Here's some crazy information, guys. Mexico just reported its steepest decline in annual production of silver in 4 years, which is notably worse than during the COVID lockdowns. Wait, hold on. They're having a worse silver decline today than COVID lockdowns. Says let us not forget, this is by far the largest producer of metal in the world today. The supply of silver remains remarkably constrained, and this is indeed the beginning of another gold cycle. the metal could be worth multiples of its current price. Look at that, guys. Here's 2020, the pullback in 2020, but look at what's going on here. It's down 19%. Now, I don't know the reasoning behind it. I don't know if it's depletion. I don't know if it's the cost curves are just too high and they're starting to cut back production. I'm not sure, but we are pulling back production. 19% is ridiculous when it's the largest producer of silver in the world. So that's crazy there. Thought that was real interesting. And that's where I'll end it, guys. So that's what we've got going on Twitter. It's all just more information that's supporting basically commodities. I'm not cherry picking this information. This information, I mean, it can be replicated by anybody. You do a uranium versus the stock chart, uranium's going to outperform no matter what you use for the most part. And all these, I try to look at it from a non-biased perspective. So I'm not trying to cherry pick data, nothing like that. It's just information that supports what basically what I think to some degree. It's stuff that's out there, and I'm trying to find information that goes counter to what I think. And all it is, the only information that's counter to basically what we're looking at would be done on a short-term time frame. So we could get a recession, we could get a slowdown, maybe things pull back. It's possible, totally, but it wouldn't be sustaining. It would only last for a short period of time, measured in months or maybe a year or a little bit longer than a year. I don't think it would last for a decade. So that's what we've got. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We do have that 50% discount coupon code going on. And that's what I've got for today. So we'll catch you guys later. This is Finding Value.